everyone, and welcome to our panel here with Moss Adams, the current state of M&A and tools to position for growth in 2021. Thank you so much for joining us. My name is Jeremy Broker, Director of Private Equity and Family Office Services here with Moss Adams, and joined by two other Moss Adams colleagues. We'll go into more fulsome introductions here in a minute, but Andrew Suen, who is a partner with Moss Adams Capital, Investment Banking and Advisory, and Chris Lang, who is our National Restructuring Practices Leader. Prior to jumping into our topic today, thought I would just kind of set the table with a bit of an update here. Just the state of mergers and acquisitions, and I've kind of broken these comments into two sections. One, and we'll be brief here, market observations, and two, things we're actually hearing from our clients. So I'll launch into that now. PitchBook recently ran a private equity poll at the beginning of Q2, where most private equity investors do not expect more than a 25% decline in deal activity. So we're about halfway through, we shall see. Really interesting here, Blackstone just marked down its private equity portfolio 21.6% in Q1. That's pretty significant from obviously one of the largest names in publicly traded private equity firms in the world. Clearly we've seen a dramatic decrease in leverage, increased scrutiny around underwriting risk, and a lot of action and question and assessment around MAE or material adverse effects of these deals. And as we've seen in the news, a lot of buyers backing out of deals. We've seen extension of exclusivity periods and portfolio company hold times. And in fact, any deals that require DOJ approval, the DOJ sent out a notice saying extend your timeline by at least 30 days for the part that you need from us on regulatory approval. A couple things that we're hearing our clients say. Number one, massive efforts to assess and shore up supply chains. Big change here in value drivers from looking at straight line EBITDA to more of a focus around free cash flow. Expectation, that we'll see a big jump in distressed deals here in the next few months. Buyers seeming to take some of the leverage back from sellers who had really kind of controlled the market here for the last number of years. While the price of a deal is obviously still critical, GP cite risk assessment and mitigation in close second. And one of the most poignant remarks here from Tim Draper at DFJ up in Northern California: raise money from your customers, not from your investors. Thought that was a pretty interesting comment, and perhaps something to noodle on. So with that, Andrew, perhaps you can provide a quick intro, and then we'll jump over to Chris Lang.
Appreciate it. Those are some fascinating topics, and we'll kind of dive into a lot of what you just kind of described here. So again, this is Andrew Suen speaking. I'm a partner in our investment banking and M&A advisory practice. Just quickly by way of background, I'm largely focused on the, call it, broader industrial manufacturing and distribution industries. I've got colleagues that also cover kind of all things consumer, from apparel and footwear, outdoor, food and bev, retail types of businesses. And our clients are typically, they're first-time sellers or family or founder-owned businesses. Revenue range, call it, 20 to 300-400 million in revenue size or so. That's kind of our sandbox.
Thanks, Andrew. Thanks, Jeremy. Chris Lang, as he mentioned, restructuring practice leader for the company. And, we do a variety of different things, anything from, definitely assessments, cash flow management, to interim management, and chief restructuring officer, financial advisor. Definitely interesting times we're living in, and there's a lot going on, and a lot has changed, even from the last 2 months and prior to that. So definitely lots of interesting situations occurring, and we'll see how that affects not only the private equity industry, but industries in general in the economy. So glad to be on the call. And thanks, Jeremy, and thanks, Andrew.
Great. All right, let's jump in, guys. Thanks for setting the table here. So as I think all three of us have noted here, the world's changed dramatically, radically. You picked the adjective in the last few months. What have been some of the most striking, immediate impacts that you've observed in how investments are being made and managed as the world and the investment community continue to respond to this situation? Andrew, why don't we kick off with you, please?
Yeah, so I think first and foremost, regardless of who you're talking to, whether it's a privately owned company that has no institutional capital, or it's the private equity owned businesses, every conversation has been, priority 1, 2, and 3 is government relief funds, government relief funds, government relief funds, right? First and foremost, you want to attack those. There has clearly been a little bit more scrutiny as of late on kind of the merit of taking on those loans and whether or not you had access to other sources of funds. But I think that is kind of the first avenue that you want to take. Private equity has been a little bit challenged, I think, in being able to access those funds. But again, for the non-sponsor backed companies, that should be a priority. What else are we hearing? Hoard cash. Everyone is hoarding cash. Cash is king. That's pretty common. We're hearing a lot of people just expanding the credit facilities. I think to your point, Jeremy, it's getting more expensive out there. The spreads are widening. You want to draw down on that revolver. Again, maintaining cash and optimizing your balance sheet is key here. And as we get through this kind of crunch of a situation, people are drawing down on that revolver. And then we are kind of hearing that people are basically asking for every deferral you can think of, whether it's a debt service deferral, whether it's a rent deferral, a utility deferral. You think of it, and people are asking for it right now. Again, cash flow management. People are scrutinizing all of the spend, right? If you have any kind of excess on the SG&A line items, those are probably going to be some of the first to go. We are hearing people kind of take pay cuts and furloughs and layoffs. Those are all on the table. So again, all of these things really under the guise of optimizing the balance sheet, the capital management, and just managing the strength of your balance sheet.
Well, I think to go along with that, Andrew, I mean, yes, obviously cash is king. Cash management is definitely something at the forefront that not necessarily wasn't at the forefront at the beginning or pre this situation. But the companies that had issues before, whether it's industry, cyclicality, economic, internal management, internal other issues, collections, vendors, even landlords. I think they are even in further of a bad situation. And when the opportunity to look at avenues to either free up cash, or to gain additional cash, gain additional capital, rework your balance sheet, is a very challenged atmosphere. And I think even 2, 3, 4 weeks ago, it was still somewhat stalled, and I think we're starting to see a little bit of opening, a little bit of change, just because it has to happen like that. And internally, management, most stakeholders are in somewhat of the same position. Now, obviously the industries can change, and some are going to lag, some are not going to lag, but they're definitely working together, definitely working with all sorts of constituents to say, hey, let's make a plan, because the odds are they're in the same situation. So what does that plan look like? How do you do that management assessment? And the board, which, sometimes if the investment is from, the private equity community, is looking at it and not as willing to throw additional money at that, whatever that may look like in the form of debt, equity, or other. So they're really looking internally to these companies to say, how do you free up cash? And if it's equipment, looking at evaluation and looking at a market to either liquidate or sell that equipment at a discount is very tough right now, because there's not a lot of markets out there. So it's really looking in deep and helping from third parties, unemotional perspectives, looking at this saying, guys, there is opportunity, but it's going to look different. So what is that? Not just today, tomorrow, 3, 6, 9 weeks, 9 months out, and really kind of strategizing around that. But it is redoing your business plan.
Great. Thank you both. Quick follow-up question this time for you, Andrew. What are you guys seeing at Moss Adams Capital with regard to repricing or retrading of deals based on, the obvious here?
Yeah, so our pipeline has been obviously very, very clearly impacted by this pandemic. There were a number of situations here in the first quarter and quite frankly in the last quarter of last year as well that were kind of on the docket, ready to be presented to the market, and then this kind of puts everything to a full halt. And so, I would say from what we're experiencing in our pipeline, it's pretty uneven, and it's going to be very, very situationally based. This pandemic, again, it's caused really, really uneven disruption, and depending on which sector you're playing in, you're feeling the pain, or you're set up pretty well, and then there's everything in between. Again, that unevenness. So and that kind of really shows in our pipeline as well. So yes, I think there have been some situations here where the deal terms are kind of getting restructured, renegotiated, retraded, however you want to describe it. And it's not necessarily just valuation, right? The headline, it can be very, very easy to get caught up in the headline valuation number. But really all the devil's in the details, right? So kind of how was all of that structured out? How are all the layers set up? And so we're seeing just changes kind of across various deal terms, but not just valuation. So we're certainly experiencing that. But on the other hand, hey, look, I would probably characterize this more the exception than the rule, but we do have at least one project here that is pretty sizable. It's going to be a pretty sizable equity check. And it's more on the consumer side with a lot of e-commerce and direct to consumer exposure. And that they're on fire, right? As everyone is kind of just sheltering in place and just staying at home, they're bored, twiddling their thumbs, and they're turning their attention, their downtime to online shopping. And so that dynamic has created a lot of positive forces for this business, and it's equity firms on the other side of it. And the capital structure is very, very conservative, and there's a big equity check coming in. So I think, again, the situations are going to be very, very different depending on what sectors you're playing in and what forces are kind of coming upon your company. But I think that, again, speaks to Chris's point earlier. I think we've moved on from just simply, hey, let's forecast the next few years, to, in a choppy economic environment that we're in, the focus has been more scenario planning. Right. Okay. Now, instead of just blanket, let's forecast us going bottom left, top right. Let's forecast some different scenarios. Let me sensitize the analysis. Let me play with the sales growth or the margin compression, or maybe not really being able to realize as much operating leverage. Whatever the case is, it's again moved from forecasting to scenario planning.
Great. Thank you for that. So for better or for worse, us humans have relatively short-term memories. And so, I think a big question that keeps coming up is obviously, how is this different than the great financial crisis, right? With a lot of people taking that question to mean, how can I protect myself, and others thinking, I think, more opportunistically about this, right? So there's a quote here I just pulled up from Rahm Emanuel. You should never let a serious crisis go to waste. That might come off as a little brash, but I think for a lot of these opportunistic investors, we're seeing private equity funds set up, obviously special sits and kind of opportunistic funds are kind of sidecars to their existing vehicles. So let's get both your perspectives, starting with Chris, as to how does this look, feel, and what do you think kind of the implications of this will be vis-a-vis the great financial crisis?
Yeah, I mean, I definitely think there's a lot of, and I say a lot, that's a relative term, but groups gearing up to not necessarily, look for the bottom feeding type scenarios, but look into industries that not only are they in, but they understand, and look to those situations to get a great deal on whatever that looks like. So is it a discount in debt? Is it buying in through that the loan to own type scenario, or is it an equity position, and giving the company a little growth, and helping them scale down, but maybe it's an add-on, a bolt-on to whatever they currently have. So I do think there's opportunities, and there's funds that have been raised to identify those opportunities and go out, not only currently, but maybe it's this summer, maybe it's this fall, and look at, what are the opportunities? Should that company exist? Should the opportunities exist? How can we help in that situation? And how can we deploy capital that, even if there is another, whether it's financial crisis, whether it's pandemic, we hope there's not another pandemic, but or second wave of things. How do you protect yourself against that? So I do think this is different than the '07, '08, even into '09 crisis, because you do not have the same drivers as you did then. Nothing shut down completely. So people were still working. There were different results of why that happened and why that needed to happen, and why there are cycles that happen like that. I mean, this I think is very different, because when things did shut down, and as Andrew mentioned, the shelter in place, that precluded people from actually doing business. And a lot of companies are restarting. So looking at that restart, how is it different this time? What is the capital that is needed and sufficiently needed, not lever to the hill and then try to put in some capital in there, and net out whatever's needed, and then really not funding that company as per it's necessary to get it some wiggle room, whether that's 6, 9, 12 months, if that's needed. So, and then what does the capital structure look like? Is it plausible, for not only steady state stabilization, but growth? And so, there's a lot of things that come into play, but I think this restart, as everybody, as was mentioned before, there has been a change to online shopping, because that's all that's available. I mean, sure, there's takeout food. So the hospitality industry has been hit, the oil and gas industry has been hit, but all the factors are changing so much, and the unknowns is where really that global risk factor needs to be played into, not only modeling what the investment would look like, but cash and planning for the future.
Yeah, and I think to kind of piggyback on that, the leverage levels of this cycle are pretty conservative. They're a lot lower than if you look at the data leading up to the Great Recession. I mean, companies are not considered, at least on the aggregate level, I would not consider over levered. Pretty conservative balance sheet still. I know there's some situations, of course, that you can kind of get into an over leveraged spot, but overall, on the whole, I think we're more conservative. The banks are much better capitalized here, and the government moved pretty quickly on just kind of the broader monetary and fiscal policies, much more quickly than they did during the last recession. So whether that is, again, that speaks to the government relief factor, right? Whether that's PPP loans for businesses, or federal stimulus checks for individuals, or the Fed asset purchases. They moved really, really quickly this time, and there's not this kind of total systemic failure of the credit markets this go around. There's a lot of credit, a lot of liquidity out in the market today, whether that's traditional bank debt, or all the private credit funds that are out there, or equity funds, or even junior capital. It's very available this go around. And what I will say is, I think much like last time, when we get on the other side of this, it does look like we're going to be in a pretty low interest rate environment for a pretty long time, for the foreseeable future here. And so as I think about the last kind of little over 10 years since the last recession, and the run up that we've seen in not just transaction value, but valuations and just growth of industry, I'd say there have been some clear winners, and I'd like to think, me being maybe more on the optimistic side, I'd like to think that we're kind of resetting, and we'll be testing higher highs here But in the interim, yeah, there's likely to be some valuation compression, deal term compression, and just kind of broader macro force compression in the interim here.
That's great. Thank you both. And Andrew, your optimism is not lost on me, not at this time. So let's make a slight shift, even though we've touched on this, to portfolio companies. Any particular insights you guys can share with respect to perhaps themes or patterns you're seeing in the responses? I know we talked about, pulling down revolvers, things of that nature. Anything in addition to that? And then have you seen any unique actions or, again, any themes develop where there's been some kind of tried and true methods or methodology amongst a subset of these portfolio companies? And then have you seen any industries perhaps responding more constructively and favorably to this pandemic? Chris, why don't you lead us off?
Sure. So I think, and this is a generalization, I think, there's always trouble, and there's always some portfolio companies that have issues. What issues those have changed and continue to change. But I think, a lot more of it is looking internally to say, hey, how can we fix this now? How can we, make things stable until we can figure out what's going on, and disposing or trying to get out, trying to get into a transaction scenario. It has changed and looked differently based on industries and based on the way the portfolio has operated. Not only the first quarter, but going into the second quarter. So it's looking at what is that value of whatever that whether it's the collateral, whether it's the equity, whether it's the value of the company in general. So I think there's a lot of changes there, and hesitancy to do something on a general basis. Now I think we've all seen there transactions still occurring, but I think a lot of that traffic is slowing down to wait and see what happens. So the realization of the dollars put in, I think is going to change a little bit, and the rationale behind that is going to change. I have seen some industries, and more so in hospitality, look at strategies of whether it's the bankruptcy scenario, whether it's the state court process scenario, to hold off certain stakeholders like the landlords. Landlords, obviously are in a very tough position, and we see that as an indicator that strategy is being utilized instead of the full-fledged. Let's stick it in the process to slow things down, and everybody go their corners to look at what needs to be done. So I think there's a lot of different things being done here, but I think it's really looking internally and revaluing, relooking at where the future needs to go.
Thanks, Chris. Quick follow-up for you. I think a lot of people are talking about, dealing with your lenders, head on, right? Being proactive. Hey, it looks like we may potentially trip up a covenant, and lenders seem to be, very willing to work with their clients here. One of the areas that's not getting a lot of attention that I'd like to get your perspective on as a CRO. How are you advising your clients who are obviously cash strapped here in dealing with their vendor renegotiations? What are some strategies that you've deployed there, things you've encouraged your clients to consider with regard to their vendor relationships?
Well, the one big thing is communication. Communication is always key when you're dealing with vendor relations, and creditor negotiations as well, bank negotiations. Because we have seen obviously lots of people are hurting, and the more you're willing to work with someone, the more they potentially are willing to work with you, and the more you're willing to communicate and either extend, rework, or utilize various methods of forecasting and looking at things in a different light, not only to get what you need from your vendors, but to pay them on a more timely basis instead of just non-communication and stoppage, which creates a lot worse situation. And understanding, and we look at our clients and say, you got to understand they're in a tough situation as well. So working, communicating is the best tactic that we feel can, and it works. But it may not work like it did 3, 6, 9 months ago. Now it's understanding and constant communication as opposed to, every month, once a month, twice a month. It can be daily or weekly right now, but it's understanding with them what that plan is and sticking to the plan.
Great. Thanks for sharing. Andrew, anything you'd like to add to the last question here, the scenarios we've discussed?
Maybe it wasn't the last question, but the one right before that, and it was more along the lines of, look, I think we've had a lot of conversations with the private equity universe, with lenders, with business owners and executives, and we're call it 2.5 months roughly into this kind of lockdown period, and I think that first month. I think there was just a lot of maybe fear, uncertainty, a lot of like, I just don't know what's going on as we are here and kind of in our third month. I think we've got a lot more clarity around our own personal situations, around our businesses, and all of the external constituents as well. And one just kind of interesting anecdote is that and this goes for both private equity backed companies and the private companies, as I'm fielding calls from them as well. But Jeremy, you and I were all talking about how the 08, 09 vintage years were actually quite robust in terms of returns, right? Well, part of that, of course, is there were some pretty depressed asset prices out there, right? So if you're buying low and selling high, I mean, the math checks out for itself. But what we're noticing is that same trend here among not just the private equity universe now, but private businesses, right? They're kind of looking inward. All right, they've spent the last month and a half, couple of months now, focusing inward, managing the P&L, managing the balance sheet, and I think the sentiment is that they've, for the most part, have kind of got it under control. They've got enough visibility. They have their action plans in place. Now, let's turn externally and decide, okay, well, are there assets, properties out there that are complementary to what we're trying to do here? Now that we've got the plan in place, the strategy is in alignment. Can we go out there and buy some other companies for what we might consider to be cheaper prices, all things considered? So we're getting that from the private equity universe, from privately held companies as well. So I think we should expect that to tick up some more as well. So and I think the last thing on that point is, again, the government relief is pretty massive out there, and I think what we're seeing right now is, Chris, you alluded to this earlier. It's kind of like this little bit of a wait and see still on the deal front. Traditional bank financing, I think anecdotally we're hearing that's coming in about, call it 1 to 2 turns of EBITDA lighter than pre-pandemic. So I think from a credit standpoint, a valuation standpoint, it probably makes sense to maybe kind of cool the jets a little bit, kind of just take a little bit of a wait and see type of approach. But in the meantime, I think it's that scenario plan, kind of planning for that kind of next transaction, and just getting yourself kind of situated for it.
Great. Thanks, Andrew. We're going to stick with you here, so don't go anywhere. Next topic. So what changes have taken place with respect to deal flow, multiples? You just touched on this, but lack of credit, which obviously it's making it much more difficult for, private equity to underwrite to their target IRRs when they're, to your point on an earlier deal, heavily equitizing these deals as opposed to getting, their 3.5, 4.5 times leverage. So I guess what are some of kind of the headlines that you would want to share with the group here, again, related to changes in deal flow, multiples, and lack of credit?
Yeah, you made a comment earlier on about deal makers maybe anticipating not more than a 25% decline in kind of deal activity, and I think I'm in alignment there actually, and in fact over the last, I'd say just recently, couple of weeks, we're in our project pipeline kind of starting to see some more movement than we had seen over the last couple of months. So And anecdotally, I'm kind of hearing that from several private equity folks as well, and other kind of investment bankers looking at what's in their pipeline. So we are seeing the spigot kind of turn on a little bit. It's pretty choppy though, right? It's not like this constant stream of deal flow coming in. It seems like it's pretty lumpy. Maybe some weeks are heavier than other weeks, but at least the spigot is beginning to turn on. So I think I'm in alignment there. Again, on that government relief, there's just this interim period is, you would think that there's kind of this valuation compression. I think you do see it a bit on the public equity side, but if you were to compare it to kind of recession levels, we're nowhere near that. We're still healthily above it. And so it's kind of created, this government relief has created this kind of valuation disconnect where, the sellers, they're putting, sometimes they'll put a COVID adjustment in there, but buyers are not just wholeheartedly accepting that adjustment. And so, there's a little bit of a battle, hence you got a bunch of deals on hold, right? So it's weird, right? You would expect some valuation compression. There has been, but to your point, I feel like the sellers they're getting so much relief right now. Would-be sellers are getting so much relief that if they're not going to get the terms that they really want in their minds, well, I guess I'll just wait it out. It's kind of the response. So anyway, that's what we're experiencing right now. But again, that spigot is beginning to turn on. And I think deals that were shelved in Q1 are starting to come back online in a little bit more full force. And then, quite frankly, I think an event like this, it's reset the timing for a lot of owners out there. And that could mean, yeah, I'm not going to enter into a transaction until way later. Or it could press it forward and say, yeah, I'm ready to call it. Let's do this. So again, it's a wholesale, I think, reset on people's just mental timing.
Thanks. And Chris, perhaps anything you want to add there, and maybe you can talk about your vantage point on lenders, flexing around some covenants. We've heard a lot of stories around, quote unquote holiday on principal payments. So perhaps again, from your perspective, what are you seeing on that front? In addition to, this one goes to either of you, your prognostication here on the go forward here cost of capital.
Well, looking at banks, are they generally relaxing on these covenants? Yes, I believe so. I did talk to some bankers, the first part of the COVID, and their response was, "We're doing tons of modifications." So I think that's the first look at things. Okay, draw up on the revolver, doing some modifications. Let's see where that gets us. And that's more the healthy companies going into this. And I think that's dealing with certain industries, infrastructure, even real estate, and various other manufacturing of certain products that are being utilized. So they're laxing a little bit on the whether it's the debt covenants, liquidity basis, and some other leverage in general. I think they're waiting to see kind of where this thing goes, because as they get into forbearance agreements, whether that's looking at it for a forbearance period of 3 months, 6 months, I think they're now really scrutinizing each one of these credits that they have, each one of these loans that they have with these companies, and looking at the company in general, and really questioning not only the viability of their business plans, but the financial information being given. So looking at it from that basis, they're really hesitant to lend a lot more money unless there are other outstanding, whether it's abundance of caution, more collateral, whether it's relaxing the covenants or releasing certain covenants to try to get that understanding and leverage to a palatable level. So I think it's looking at that, and I think as time goes on, and things get more lax, on the shelter in place, and go back to what we consider more normal than has been. I definitely think the banks are going to have to work with these companies to get something that makes sense. Otherwise you're going to have banks with having to reserve more capital, banks with bigger special asset situations, and get into the foreclosure situations and the liquidations, of which and those would be tough scenarios right
Great. Thank you, Chris. Andrew, anything you can share relative to kind of the current state scenario of, just kind of up and down the capital stack, cost of capital, and then any significant or meaningful changes in the next 6, 12, 18 months to the cost of various forms of capital here?
Yeah, and I think Chris, you alluded to this, touched upon it on the senior lending side. Look, spreads are widening. I think banks are in fact kind of working with their clients on the covenants and kind of relaxing certain criteria. But I also think that look, pricing is up. That's what we're hearing. And if particularly, for example, if you have a line of credit in place, but you're looking for an expansion of that, we're also hearing that the incremental piece of expansion is priced at a higher level than the base piece, right? So that's just happening across the board. And that seems to make sense, right? On top of the normal course, business and portfolio risk, right? That lenders are sizing up constantly. Now you have to layer on top of all this a very, very heightened level of policy risk and policy uncertainty, right? I mean, the banks are the ones that are, underwriting the loans, and is it backstopped? Yes or no? How is it actually forgiven? Right? At the end of the day, the banks, they're not going to be the ones that are they're going to want to hold the bag at the end of all of this. So until there is some very, very clear cut kind of guidelines on the forgiveness piece, I think it's only going to get a little, more expensive here as policy risk weighs in. So, I know the government is addressing all of that kind of piecemeal and piece by piece, but until then, until there's full clarity around it, I think we should expect a more costly type of capital environment. Moving into, call it the private credit funds. I think those are actually a really, really good option, right? At the end of the day, they're a fund, right? So they have to deploy capital or they return it, right? At the end of the day. But I am hearing that the pricing on that, it's pretty in line with the traditional bank debt, these days. It's not really too materially different. And so that's a very, very viable alternative to the traditional bank debt. On the kind of, call it, junior capital side, the subordinated debt, mezz debt, I think we're hearing that that's, maybe ticked up just a little bit. I don't know that I've heard anything too materially different. I think the debt piece is probably moved up a little bit on the cash pay. There's, I think the PIK pay is relatively in line still. And then, of course, the equity capital is always going to be the most expensive, right? And that's always kind of a negotiation on the value and those sorts of things. But at the end of the day, they're funds as well, and they are very much looking to deploy that capital. But I think prudence is and discipline are going to kind of reign supreme here in this environment. Just because they have the capital, it doesn't mean that they're going to jump right in without looking, right? It's every bit of diligence is going to happen, if not more, right, under an environment like this. So that's the one thing on the lending piece. If I may just kind of jump in real quickly on a couple of other pieces that we're noting, just maybe on the private equity side, is that last year we had a couple of minority capital situations, and leading up to this pandemic, I'd say for the most part there was just a lot more majority capital out there. It's like I'm a control investor, really not interested in being in the minority, so we'll pass, right? So there's a lot of that. Now, fast forward to today, post-crisis, I think capital has become a lot more flexible in the sense of, okay, guys, it's not just about control anymore. We want to be a good partner to you. We want to build a relationship. So why don't we just take a smaller slug up front today? We'll still need a clear path to majority at some point in time, but why don't we do a minority piece now, kind of evaluate it, kind of grow with you, and then we'll kind of take down a bigger bite a little bit later. So we're hearing that a lot more. The capital has indeed become a little bit more flexible. And then along the same vein there, I think there were maybe some smaller situations or some hairier situations that were just less attractive or didn't totally fit their portfolio. I think they're dusting off those older deals. They're kind of reevaluating things and maybe maybe it didn't fit perfectly, but at the right price, it does fit, right? So those are some, just again, some observations that we're noting on the kind of professional investor side as well.
Yeah, all very well taken. On the where I spend most of my time is working with our transaction services folks, and I would say about 30 to 40% of the deal flow that we're seeing on the buy side quality of earnings front is private credit, fast and furious there, and certainly a lot more on the minority side, even from these otherwise control investors. Take it back a year ago, who have pulled who have allocated some of the control investment fund that was, set forth to do that, and are making these minority investments, as you state, with a then clear path toward. And so with that, seeing a lot of, what in the venture community they'll call an inside round, or in private equity is known as follow-on investment, right? Since we can't travel, we can't meet new management teams, we're seeing a lot of that, kind of follow-on investment, and or these financial sponsors getting in early to then create that path to eventual control of any given asset. So I thank you both so much. We're not going to let you go quite yet, but for those of you that have stuck with us, there's a contact form below the video here. We've got a link set up. Please feel free to send in any questions, comments, inquiries, etc. We'll be sure to get back to you and appreciate any and all feedback there. So we'll end in the traditional way here, since no one on this webinar knows when we're going to have a ubiquitously available vaccine. So absent that, we're just going to go to the banal wrap up here and talk about some key takeaways. I wrote down a few, and then let's turn to Chris and Andrew. Communicate sounds simple. Simple is not always easy. Will be the little edict I'll add there. Something Benjamin Graham, started talking about many decades ago. Buy low, sell high. Again, sounds very simple. I can tell you anecdotally and personally, it is not. And then dust off your old deals, right? So we're hearing and seeing a lot of that. So those are a couple that I picked up here. Would love to hear your closing thoughts, Chris.
Sure, and thank you. And yeah, I mean, definitely, and from my perspective, communicate and the ability to work with all the parties that are involved. And there is opportunity, and to look at the positive as well as the negative aspects of this, but to look at not only the short term, whether it's short term loss, short term gain, look at the longer term approach and the longer term goals. And I think there's going to be opportunity. There's going to be not only the creditors, credit funds, private equity, but also the companies more willing to work together and more having the ability to understand all facets and what is needed in order to not only stabilize, but be profitable in growth in the long term.
Yeah, I think regardless of whether you're a buyer, you're a seller, or you're just an owner that isn't looking to do either, I think the key here is that, again, scenario planning. Really have a good, firm understanding of your cash flow, of your P&L, your balance sheet, and your cash flow statement. Just a very firm understanding there. And plan for different scenarios, upside, downside, base case. I think that's some of the most valuable work that we're doing right now for our clients, we've had for years now, 2, 3, 4, 5 years. And it truly is advisory type of work. They're not quite ready yet for personal reasons or business reasons, whatever the case may be, but that shouldn't change the fact that you need to really have this hyper focus, hyper attention on your cash flow. And so, those are the, again, most valuable projects we're doing right now. And as you look back on some of those clients, the last 3 years, we've done monthly forecasts and scenario planning for them. And you fast forward to today and you compare how well you did in your projection, it just gives you a lot more comfort when you're really ready, that with the materials that are ultimately presented to the marketplace, you feel really comfortable about, that you've beta tested it, there's trial and error, and that you've really vetted it. So that's kind of the primary focus here today.
That's great. Well, Chris Lang, Andrew Suen, thank you guys so much for spending the time, as well to my 3 and 5-year-old. They've never been this quiet this long. Ice cream this afternoon. And for everyone who joined us here again, look forward to receiving any comments or questions. And with that, we'll sign off. Thank you everyone for joining us today.
Thank you.